Every major economic collapse in modern history shared one brutal truth. The people who came out of it with more wealth were not the ones reacting after the crash. They were the ones preparing long before the headlines turned ugly. For years, the public has been sold a comforting version of finance. Crashes are random, diversification is enough. Stay calm, stay invested, and never try to see it coming. For the average person, that advice sounds sensible. But when you study what the wealthiest investors, institutions, and private capital groups actually do, a very different pattern begins to appear. They do not wait for panic. They position 18 to 24 months before the damage becomes obvious. And they do it using the same categories of assets again and again. The first move is the one most people ignore because it feels too simple to matter. They pile into short-term government paper, treasury bills, and cash equivalents, not because they are scared, but because they understand something most people never do. Cash is not laziness. Cash is optionality. Before major downturns, the wealthiest players don't chase the last few points of upside. They build liquidity. They put themselves in a position where, when everybody else is forced to sell, they are one of the few groups capable of buying. That is the real power of cash in a collapsing market. It is not the return it earns while you wait. It is the freedom it gives you when quality assets are suddenly being sold at desperate prices. When markets crash, great companies, prime real estate, and entire industries can trade at discounts that only exist because fear overwhelms logic. The wealthy don't see cash as dead money. They see it as loaded ammunition. They understand that every crash eventually becomes a clearance sale for those who are liquid enough to act. The second asset is where the real machinery of wealth transfer becomes visible. Distressed debt. When businesses begin to fail, their bonds often collapse in price. Instruments once considered safe start trading at 20 cents on the dollar, sometimes even less. To most people, that looks like poison. To sophisticated capital, it looks like a doorway. Because in a bankruptcy, ownership doesn't always go to shareholders. It often goes to creditors. That is the part most people never fully understand. Equity holders can be wiped out, but debt holders, especially those higher in the capital structure, can emerge from restructuring with control, assets, and new equity in the reorganized company. In other words, they did not buy the stock when it was expensive. They bought the debt when everybody else assumed it was worthless, and they came out owning the business. This is how major fortunes are quietly built during recessions, not by predicting a perfect bottom, but by understanding that panic creates legal pathways to acquire productive assets for pennies on the dollar. Every corporate collapse that terrifies the public creates a hunting ground for those who know how bankruptcy really works. The third asset is older than every modern financial market and stronger than most of them in a crisis. Productive agricultural land. Not land for speculation, not land based on a story, land that produces food. Across history, when currencies failed, when banks collapsed, when empires weakened, one form of value kept returning to the surface. The ability to produce calories. That is what makes farmland different. It is tied to a demand that does not disappear in a recession. People can postpone buying luxury goods, they can stop traveling, they can reduce spending, but they cannot opt out of eating. That gives productive farmland a floor under its value that many financial assets simply do not have. It is not just dirt, it is a claim on biological necessity. And when that land is linked to export demand or global food systems, its resilience becomes even stronger. This is why powerful investors accumulate it quietly and hold it across decades. They are not buying romance, they are buying permanence. When paper wealth becomes unstable, productive land becomes something much deeper than an investment. It becomes a store of real-world utility. The fourth asset lives in a world most people associate with culture, status, and taste. But behind the curtain, it often behaves like strategic capital. Blue-chip fine art, not random pieces, not trend-driven speculation. The highest quality works with deep collector demand, museum-level legitimacy, and permanently limited supply. What makes top-tier art valuable in periods of economic stress is not beauty alone. It is scarcity that cannot be manufactured. A central bank can expand money supply. A government can print more currency. Markets can inflate financial assets through leverage and policy. But no one can create another masterpiece by a dead artist whose work has already been absorbed into the highest levels of private and institutional collections. That scarcity matters most when monetary systems become unstable and wealth begins searching for hard stores of value outside public markets. Art also carries another advantage for the ultra-wealthy. It often moves through private channels, negotiated away from the public eye, where discounts can be extracted from sellers needing liquidity and where price discovery is far less transparent than in stocks or bonds. That opacity is not a flaw. For serious money, it is part of the attraction. In uncertain times, art becomes a quiet vault disguised as culture. The fifth asset is where preservation turns into aggression. Essential service monopoly-style businesses. This is where entirely new fortunes are built during downturns. Waste management, self-storage, funeral services, pest control, water infrastructure, medical waste processing. Businesses people barely talk about when the economy is booming. They are not glamorous. They do not go viral. They do not come wrapped in the language of disruption or innovation. But they share one powerful characteristic. Demand for their services does not disappear just because the economy contracts. Families still create trash. People still downsize and need storage. Infestations still happen. Water still needs treatment. Death does not pause for a recession. These businesses often keep producing cash flow even while the broader economy suffers. And when downturns squeeze smaller operators with debt, labor issues, or declining access to financing, larger and better capitalized buyers step in. They acquire contracts, routes, equipment, customer bases, and local market share at distressed prices. By the time the recovery arrives, they don't just own a business. They own the market. This is how boring sectors become gold mines. They were ignored during the hype cycle, so they never got absurdly overpriced. Then, the downturn makes them even cheaper, while their revenue base remains stubbornly alive. That combination is almost unfair in its power. And once you see these patterns together, a larger truth becomes impossible to ignore. Crashes are not just moments of destruction. They are moments of redistribution. Wealth moves from the unprepared to the prepared, from people forced to sell into weakness to people who spent months or years building the position to buy. The public experiences collapse as fear. Sophisticated capital experiences it as deployment. That is why the same behavior keeps repeating. Liquidity gets built before the event. Distressed opportunities are studied before the panic. Hard assets are accumulated before trust in paper starts to crack. Essential cash flow businesses are identified before smaller competitors are pushed to the edge. None of this is random. The most important lesson is not that you need access to every elite vehicle on earth. It is that the logic behind them is visible. Cash is not cowardice, it is control. Distressed debt is not chaos, it is hidden ownership. Farmland is not old-fashioned, it is necessity made tangible. Fine art is not just luxury, it is scarcity with status. Essential service businesses are not boring. They are recession-proof cash engines waiting to be consolidated. So the real question is not whether another downturn will come. History already answered that. The real question is whether you will enter the next one positioned like the crowd or positioned like the people who understand what a crash really is. Because for the middle class, a collapse often feels like something that happens to them. For the wealthy, it has often functioned like a scheduled transfer event. And the people who know that do not wait for permission from the headlines. They prepare while everyone else is still being told there is nothing to prepare for.